June 20, a lot to talk about, a lot going on in the economy, a lot of the things that we've been forecasting and talking about since really December of last year are now coming into play. So that said, I'll jump right in here. We're going to talk about this week. Does this confirm that we were right about the recession? Is deflation about to enter the room? And the question of the day, is the Fed now more focused on the narrative than the economic outcome? And I think we're witnessing the beginning of what I would call tech stock collapse take two. Non-profitable companies are now scrambling to cut costs before their inevitable collapse, in my view. As we go through the material today, if you do have a question, go ahead and type it in the questions box on the, or the questions area, I should say, on the right-hand side of your screen. Mark will keep me alerted to the fact that there may be a question or comment. I'll keep an eye out for it as well. That said, let's jump right in. Seems like we might have been right about the recession. During the first quarter, I had said that I thought that as economic data was revised, as GDP growth was revised, that eventually it would show that we are in a recession. That is exactly what has happened. The Atlanta Fed, this is from June 15, Atlanta Fed slashes the second quarter GDP forecast to 0, confirming a technical recession. Curious why stocks are soaring today ahead of an expected 75 basis point rate hike by the Fed. The answer comes courtesy of the Atlanta Fed, which just confirmed the economy is now in an official recession. After a week of rampant jawboning to adjust the market's expectation for the Fed's actions later today, the continued erosion in economic data has prompted the Atlanta Fed to slash its forecast for second quarter GDP growth from 0.9% down to 0%. So that means that we now are in a recession. It might be enough, as you'll see from the Zero Hedge tweet, to get us to negative growth for the second consecutive quarter. Now, according to the Atlanta Fed's GDP Now model, growth has been cut to 0, flat. Originally, on May 27, the estimate was for 1.9%. June 1, it was adjusted to 1.3%. June 6, it was adjusted to 0.9%, and now 0, which is exactly how this usually plays out. It goes from more optimistic to less optimistic. And when you factor in the massive dollar devaluation that has taken place, and you adjust for the purchasing power of the dollar, we are certainly in a recession. Now, Jamie Dimon, the CEO of a major financial company, talked about the fact, I brought this up last week, that first he said we are approaching an economic storm. We have storm clouds on the horizon. 9 days after he made that comment, he revised his comments to say, no, I think it's more like an economic hurricane. Now, if you take a look at the chart on this page, this is a chart that shows the city economic surprise number, and you can see that it's absolutely plummeted. And longer term, the trend towards stagflation, which is inflation with a contracting economy, could not be clearer. And if you look at the blue line at the top of the chart, that is the University of Michigan expected change in prices. You can see that as time has passed, consumers are expecting that prices will continue to rise. And the red line is the GDP forecast for the Atlanta Fed. So you can see those lines are widening, indicating stagflation. Now, the forecast, and actually this is a forecast repeated, I believe in the not too distant future, the Fed's going to have to reverse course and they're going to begin easing once again. That will likely move us toward what the economist Ludwig von Mises described as a crack up boom. So I think that's the direction in which we're moving. Of course, if the Fed stays the course, which again, I don't expect, we'll move right into a deflationary environment. That's a perfect segue to this article And the question I'm asking here is deflation about to enter the room? This article, titled Deflationary Tsunami on Deck, a tidal wave of discounts and crashing prices. This article, also from Zero Hedge, talks about the fact that the author of this article 3 weeks ago talked about the bullwhip effect reversal. So essentially what they're talking about is the inventory to sales ratio. And this looks at different retail sectors, including furniture and home furnishings, appliances, building materials, garden equipment, general merchandise sold at stores like Walmart and Target. This inventory to sales ratio is now higher than it has been at any time since just prior to the bursting of the dot-com bubble. That is not a good omen, not a good sign. So what does this mean? Well, widespread inventory liquidations, according to the author of this article. Now, I believe that you're not going to see, as this article said, every price cut. I think that prices will be cut on items that are purchased with discretionary income. So if you take a look at furniture, if you take a look at appliances, those are things that are often purchased with discretionary income. I think you're likely going to see those prices fall. Gas and groceries will likely not stall, but not fall. I think they're going to continue to rise. So Wall Street and the mainstream media are now predicting unprecedented deflationary price cuts in the coming weeks. Now, just because it's reported on mainstream media doesn't necessarily mean that I personally am going to buy into that. However, when you look at the numbers, you have to believe that we're going to see this. Michael Wilson, who's a Morgan Stanley strategist, wrote that while there's a modest pickup in oversales, the far more concerning issue is that inventory across the sector is up about 30% year over year, and sales growth is up about 0% year over year, translating to about 30% year over year excess inventory. And while markdown and margin pressure did not hit in the first quarter, according to Mr. Wilson, it will hit in June, July. We're right on the brink of that, according to Mr. Wilson. He wrote that store checks show that aggressive discounting has already started as of the Memorial Day weekend. Discounting pressure could accelerate through July. And more retailers are now discounting. It gets much worse, though, because of the delayed nature of this bullwhip effect that the article is talking about. Morgan Stanley thinks it'll be some time before retailers can cut back on forward inventory orders. Companies are no longer in a position to order 6 months in advance because of delays in the supply chain and are currently working with about an 8-month lead time. This means decisions today to cut future orders won't begin to eliminate the inventory problem until the first quarter of next year. The Wall Street Journal commented on this as well. This is an article written by Rachel Wolf on June 14. The title of the article is "Stores Have Too Much Stuff. Here's Why They're Slashing Prices." The article starts out by saying big discounts are coming, calling all shoppers. Target, Walmart, and Macy's announced they're starting to receive large shipments of outdoor furniture, loungewear, and electronics everyone wanted, but they couldn't find during the pandemic. The problem for retailers is that these goods have been delayed for about 2 years, and that delay could end up being a windfall if you're in the market for a couch or sweatpants. The Wall Street Journal said prices are going to begin dropping around July 4. Mickey Chatta, who is a Moody's Investor Service analyst, said there's going to be discounts like you've never seen before. Now, retailer discounts are part of an effort to get shoppers interested in buying things again. As Americans shift their spending to concerts, eating out, and travel they missed out on. Deep discounts are expected on oversized couches, appliance and patio furniture, these are items that take up a lot of space in warehouses. Stores are going to be discounting largely, again, furniture and sweatpants. Office wear might not be discounted, according to one analyst. Target and other retailers have already announced they're planning big discounts. Walmart has a lot more warehouse inventory, and they might be more likely to hang on to their excess inventory, according to some analysts. Now, retailers who sell their own lines of clothing and decor, like Gap, could be especially inclined to mark down their inventory, Mr. Chadha says, because they can't pass the cost on anyone else. Companies that carry other brands like Macy's can maybe go back and pass some of the surplus back to the producers. Consumer electronics are likely going to be another category that you'll see big discounts. The chip shortage is now not such a big deal, and items like TVs and laptops are likely going to be on sale. So as I said in past webinars, as you move from inflation to deflation, that move is not clear cut. That move is not 100%. That move is not all in. As you move from inflation to deflation, you see some inflationary trends and some deflationary trends, and I think that's what we're starting to see.
We have now, two questions before we move to the next topic, if you will.
Yeah, Mark, thank you. You bet.
All right, so the first one comes from Dave. He says, given the fact the Fed is not going to continue to raise interest rates, at what point would you start buying treasuries?
I think that, first of all, we have to wait and see what the Fed does. The Fed has, and this kind of leads into the next topic, which may answer this question to in a little more detail. The Fed has said that they're going to continue raising interest rates. And as I've said in the past, I think it's pretty obvious they're not raising interest rates fast enough to make any meaningful difference as far as inflation is concerned. My take is that, as you indicate, that if the Fed starts easing again, it'll create a temporary bull market in treasuries. I think you have to wait to see what the Fed does. But as soon as there's an announcement, or as soon as you hear the Fed saying that, hey, the economy's slowing, we're in recession, we've got to accommodate, we've got to add liquidity, that would be a cue to probably add to U.S. Treasuries. In this week's Portfolio Watch newsletter, I comment on this, and if you take a look at the chart that I put in Portfolio Watch this week, which you can get at Retirement Lifestyle Advocates website, retirementlifestyleadvocates.com, that'll be available about 5 o'clock tonight. You'll see that I went through and analyzed the U.S. Treasury market. The U.S. Treasuries at this point are very, very oversold. Doesn't mean it's time to buy them. As I mentioned in the newsletter, there's an old market adage that suggests you never try to catch a falling knife. And I believe that's really what you'd be if you bought treasuries here. But as soon as the Fed officially announces that, if you're a trader, I think it's going to be a good time to buy U.S. Treasuries. But I would wait for an announcement. Hopefully that answers the question.
All right. And the second question comes from Jeff. It says, does it make sense that the widespread price cuts will still take place amidst the ongoing supply chain issues?
Well, I think, Jeff, a lot of what we're seeing here is that a lot of the supply chain issues now are not as much of an issue simply because consumer demand is declining. So we had supply chain issues when there was a lot of government stimulus floating around in the economy and everybody had excess money to spend, or a lot of people did. That's not the case now. As I've discussed here on these Headline Roundup webinars, from February to March this year, credit card debt more than doubled. I had dinner with a friend of mine last week, who's to be in a retail business, he's in the tire business. And he said he's noticed in the past few months that many people are coming in and putting very small purchases on credit cards, when before most of those purchases were paid in cash. So I think you're seeing that this inflation is really making an impact on the way people spend. And I think that a lot of the items that I talked about, furniture, appliances, computers, TVs, those are items that people buy with discretionary income, and those are items that they don't necessarily have to buy. So I think that is the type of purchase that you're going to see prices decline on. So hopefully that answers the question as well.
That's all the questions we have at the moment. If you have a question, type it in and we'll get it answered.
Yeah, Mark, thanks. Thanks for that. Let me, there we go. I've got, technically on my end, I'm ready to go, so I can see the slide again here. So the question here is, and I would argue that this is the case, and I did that on the radio show this week, and the podcast will be posted tonight at 5 o'clock, is the Fed now focused more on the narrative? Are they focused more on the story they put out there than they are on the economic outcome? Well, the Fed hiked rates by 75 basis points. That's 0.75% last week. That's the most since 1994. The most that the Fed has hiked interest rates in 18 years. That tells you that in and of itself, that 18-year time frame tells you that we have had very much an artificial economy and artificial markets. The Fed sees only marginal impacts of these aggressive, strongly committed inflation-fighting rate hikes on the unemployment rate. Former New York Federal Reserve President Bill Dudley said, "I think the Fed's forecasts are still remarkably optimistic. This is a very soft landing sort of forecast." As I said on the radio show back on a couple weeks ago, and it was a best of program this past week, I think that a snowman has a better chance of surviving in your front yard between now and the 4th of July than the Fed has of somehow creating a soft landing here. And a soft landing would be defined as getting inflation under control and avoiding recession. In fact, I think it's too late for that at this point. Now, Powell, referring to the chair of the Federal Reserve, Jerome Powell, prevaricated all over the place during his presser to persuade listeners that the U.S. economy is in a strong position and well positioned to deal with higher interest rates. I don't believe the Fed chair actually believes that. The article writer makes kind of a strong accusation here about Powell, stating that Powell shifted from prevarication to total perjury when, on the day that retail sales printed negative and the Atlanta Fed said there's no economic growth, well, as that data was coming out, Powell said there is no sign of a broader slowdown in the economy that I can see, despite the fact that the Atlanta Fed said we've got a 0% growth rate economy. So I believe that Powell is more interested in the narrative than they are on the outcome. Now, the data does not back up what Powell said. In fact, let me go back a slide. Powell said there's no sign of a broader slowdown in the economy that I can see, and yet, when you go back and look at that economic surprise chart, you see the economic data has done nothing but collapse over the past month. And the article writer points out that the Fed at one time said that inflation would be transitory. We told you at the time that would likely not be true. I believe that there is a broader economic slowdown also that at this point I think has arrived, but I think it will have to intensify. The article writer asks a very good question. If everything is so awesome, why are major firms announcing mass layoffs and why are they cutting guidance? Good questions. Richter had an interesting piece this past week, and I've titled this section, Tech Stock Collapse Take 2. Non-profitable companies are now scrambling to cut costs before what will be, I believe, an inevitable collapse. The title of Richter's article is Real Estate Tech in Existential Crisis as Housing Sours, Stocks Plunge, New Money is Out of Reach, Redfin and Compass try to survive by cutting staff, Opendoor and Zillow sag. Here's the problem, according to Richter, and I certainly agree with him. Here's the problem with companies whose hype and hoopla stocks have collapsed by 80 or 90%. They're facing an existential crisis. They cannot raise more money, but their operations were never designed to make money in the first place. Just like the tech stocks back in the late 90s. Many of you remember that. Their business model relied on burning cash, and the whole thing was designed from the get-go to use homemade growth metrics to bamboozle investors into buying stock and pump up the shares. Then the companies, based on their high share price, could issue more shares and raise more money and feed their cash burn machine. Their plan was to fake it until they make it. But with their shares down 80 or 90%, they can't fake it any longer. And they can't sell more shares because nobody's buying them. And they're going to run out of cash and they won't be able to cover their expenses. That's what happens when you have to sell more shares to stay in business. At some point, you cease to exist and your shares become worthless. Not worth less, but worthless. Richter points out correctly that they have to get outflows under control, so you have to start making cuts. And if you can't cut your costs fast enough, if you can't get your expenses under control, if you can't take in more than you spend, eventually you run out of money. And then your business closes down. And that's what's going on now. There are hundreds of companies, according to Richter, in this position that went public during the hype and hoopla area of money printing and interest rate repression. And they're all fundamentally facing the same crisis. Though each company has unique challenges, and in addition, all have to face their industry challenges. So Richter focuses on the real estate tech industry. These are companies that have great technologies, great online presence, great online tools in the real estate area. Compass and Redfin announced job cuts. Zillow, which is also in real estate tech, has been laying people off since last year. And Opendoor, which is a home flipper, went through a bunch of layoffs as well. Now, they all have one thing in common. They lost lots of money every year of their existence as a publicly traded company. Bottom line is, if a company doesn't make profits, there will be a day that that company will no longer exist. We learned that when the tech stocks fell apart. We're learning it again in real estate tech. Redfin, the CEO, Glenn Kelman, called Redfin the Amazon of real estate. However, they have decided to lay off 8% of their staff because Kelman said it's now time to make money. We're losing many good people, Kelman said, but in order for the rest to want to stay, we have to increase Redfin's value. And to increase our value, we have to make money. What an interesting idea. What an interesting concept that a business actually has to make money. That's actually the way it always works. And there's just been a couple time frames in the last 2 decades that companies that have not made a profit have had successful IPOs, but those are really aberrations. That's not normal. Kelman said May demand was 17% below expectations. There was not enough work for our agents, not enough work for our support staff. And much of this had to do with the fact that mortgage rates just went over 6%. Now, Redfin has traded publicly since 2017. And prior to going public, it existed for 13 years. And now the company is saying we need to make money. Richter says, oopsies palooza. I mean, WTF. I'll let you fill in the blanks there. Redfin on the news fell to a new closing low of $8.13 a share. It went public at the IPO price of $15. Shares went to $30, but now they're down about 75%. Now, if you take a look at Redfin, the Redfin stock chart, you see that it really spiked in March of 2020, going through January of 2021, and now it has fallen and it's back to where it started. That price chart illustrates a bubble. And what's interesting about a bubble is they tend to be symmetrical, and you see that from the chart. They take about as long to unwind as they do to build, and they tend to fall about as far, and they end up losing really as much as they gain. And that's exactly what's happened here. Compass, another company, announced that they were going to eliminate 10% of its staff, or about 450 people. It shut down its title and escrow company, Modus Technologies. It's getting out of some office leases, and it's not pursuing any more acquisitions. The real estate brokerage was backed by SoftBank, and it raised $1.5 billion before the IPO, which it then spent, plus the money it raised in the IPO. It spent everything on buying up real estate brokerages and hiring brokers away from other brokerages. Now it's trying to cost cut its way to positive cash flow after it couldn't make money in what was for years the hottest housing market ever. I mean, if you're in real estate and you haven't made money in the past several years, you're simply not going to make money. And the real estate market is, as I've been predicting, starting to slow. There is a chart of Compass stocks as well. Zillow has not recently announced any layoff announcements, but take a look at the Zillow stock chart and compare it to the Redfin stock chart. They look very similar. That is the epitome of a bubble. Zillow shares down 86% from the high in February of 2021. Open Door Technologies, that looks a lot like the Compass stock chart. You see that is dropped from more than $35 now to about $5, down 87%. So that's really what I wanted to talk about today. Let me just pop that back up here and just see if anybody has any questions before we finish up. We are a few minutes over, but if you have a question, go ahead and type it in the question box on the right-hand side of the screen, and Mark will let me know it's there. I'll try to look for it as well, and certainly we'll do our best to answer your question here.
I have one question from Jeff. That question is, if these deflationary forces do appear, then won't they take the Fed off the hook, i.e. making it easier for them to stop raising rates and maybe even begin lowering them again through more QE? If so, it would seem that this would light a rocket under precious metals. No?
Well, as everyone here knows, I'm bullish on precious metals. In the newsletter this week, I point out that gold has really formed a cup and handle pattern, and I believe it's a very bullish pattern moving ahead. Stocks and U.S. Treasuries are very, very oversold, so I think the drawdown that you're seeing in a permanent portfolio, which is about 10% year to date, I believe that will be temporary for the reasons that we just talked about here. Getting to your core question, Jeff, I believe if the deflationary forces do appear, I believe it will take the Fed off the hook to some extent. I do not believe, however, that we're going to see a decline in essentials. I think you're going to see stagflation. So I think you're going to see a decline in asset prices like stocks and real estate. You'll probably see a decline in items that are purchased with discretionary income, but I do not expect that essentials will escape inflation. So I believe if the Fed starts to engage in easing, whatever you want to call that easing, I believe you're going to have certain sectors that will be affected by that easing, and you'll have inflation, but I believe you'll have deflation in other asset classes. So I hope that answers your question.
That's the last question.
Well, that's good timing because I have 12:34 on my clock, so that gets us to where we usually stop. We will be back live again next week. Next week is the 27th. If you look ahead to the following week, then it's hard to believe, but the following week gets us to the 4th of July weekend. So actually, 2 weeks from today is the 4th of July. We will not have a headline roundup webinar on the 4th of July. We will, however, be back on the 11th live. So live the 27th, no webinar on the 4th, and we'll be back again live on the 11th. Thank you all for participating. Thanks for all the nice things you're saying about us. Have a good week.